Welcome. Today, we are going to explore the order book in the stock market and learn how it can help you make better decisions when trading. By the end of this guide, you will understand how to read an order book, how to spot key signals, and how to use this tool to improve your trading. So stick with me and let us get started. Have you ever wished you could see exactly what is happening in the market as it unfolds? Well, the order book does exactly that. It gives you a front row seat to every buy and sell order for a stock in real time. The order book is like a window into the market, showing you how much buyers are willing to pay and how much sellers are asking. This level of transparency is incredibly powerful because it helps you understand supply and demand dynamics. Imagine knowing what everyone is offering to buy or sell something for in a marketplace. You get to see where the interest is, where people are taking action, and where the prices are likely to go next. By keeping an eye on the order book, you can even identify areas of potential support or resistance before they appear on a price chart. Now, let us expand on chart patterns that you might see when analyzing these areas of support and resistance. Chart patterns are visual formations that traders use to predict future price movements based on historical behavior. One common pattern is the double bottom, which looks like the letter W. This pattern appears when the price drops to a support level, bounces up, and then falls back to the same support level again before finally rising. It suggests that the support level is strong and buyers are stepping in, which could lead to a price increase. Another pattern is the head and shoulders, which usually signals a reversal. It features three peaks, with the middle peak being the highest, resembling a head with two shoulders. When this pattern forms, it often means the price could be headed down. There are also continuation patterns, such as flags and pennants. A flag pattern forms when the price moves sharply in one direction, then consolidates in a small, rectangular range before continuing in the original direction. This indicates a brief pause before the trend continues. Pennants are similar, but they form a triangular shape as the price consolidates. Both of these patterns can help you understand when a trend is likely to resume. One more helpful pattern is the ascending triangle, which forms when the price hits resistance at the same level multiple times, but continues to make higher lows. This shows that buyers are getting stronger, and if the price breaks above the resistance, it often leads to a significant move higher. The opposite of this is the descending triangle, where the price makes lower highs while repeatedly testing a support level, which could signal a breakdown if the support fails. Recognizing these chart patterns while watching the order book can give you extra confidence in your decisions. For example, if you see a double bottom forming while there are large buy orders at the support level in the order book, it could be a strong signal to buy. Similarly, if a head and shoulders pattern appears and the sell orders are stacking up, it might be time to consider selling or avoiding a long position. Chart patterns do not guarantee what will happen, but they do give you clues that, when combined with the order book and other indicators, can help you make better trading decisions. Keep practicing spotting these patterns, and over time, you will start to see how they can fit into your trading strategy. Now, let us break down how an order book is set up. On one side, you have all the buy orders. These are called bids, and they are organized from the highest to the lowest price that people are willing to pay. On the other side, you have the sell orders, called asks. They are arranged from the lowest price that sellers are willing to accept all the way up. You can think of these as two sides of a marketplace, one with buyers and one with sellers, each showing what they are ready to do. The order book does not just show the best prices, but also multiple levels of prices. This way, you get a full picture of where people are interested in buying and selling. It is like looking at not just the top offer, but also seeing everyone else in line and knowing what they are thinking. Now let us expand on how chart patterns come into play with understanding the order book. Chart patterns are essential because they help visualize the behavior of buyers and sellers over time, and they can often signal future movements in the stock price. One well-known pattern is the *** double bottom ***, which looks like the letter W. This pattern indicates that the price has fallen to a certain support level, bounced up, then fallen back to that same level again before rising. This tells us that the support level is holding strong and that buyers are stepping in repeatedly at that price point. When you see a double bottom forming along with strong buy orders at that price level in the order book, it is usually a good indication of a potential price increase. Another important pattern is the ** head and shoulders ** pattern. This formation features 3 peaks, with the middle one being the highest, resembling a head flanked by 2 shoulders. When this pattern forms, it often signals a reversal in the price direction, meaning the stock could be about to fall. If you are also noticing large sell orders appearing at the shoulder levels in the order book, it gives you an even stronger clue that the price may be about to drop. ** continuation patterns ** such as flags and pennants are also crucial to understand. A flag pattern forms when the price makes a strong move in one direction, followed by a brief period of consolidation where the price moves within a small rectangular range. The expectation is that the price will continue in the direction of the original move. Pennants are similar, but they tend to form a more triangular shape as the price consolidates. Both of these patterns suggest that the current trend will likely continue. If you see the order book showing buy orders building up during the consolidation period of a bullish flag, this can add confidence that the price is set to continue upward. There are also ***, ascending and descending triangles ***, which are patterns that suggest potential breakouts. An ascending triangle forms when the price makes higher lows while hitting the same resistance level multiple times. This tells us that buyers are getting more aggressive and the pressure against the resistance is building. If the price finally breaks through that resistance, it is likely to make a significant move upward. When you see this pattern, along with growing buy orders just below the resistance level in the order book, it is a strong signal to watch for a breakout. On the other hand, a descending triangle forms when the price makes lower highs while repeatedly testing a support level, indicating that sellers are becoming more aggressive. If the support level breaks, the price could drop sharply. Observing large sell orders near the resistance can help confirm the strength of this pattern. There is also the ** cup and handle ** pattern, which is a bullish continuation pattern. The cup part of the pattern looks like a bowl with a rounded bottom, showing that the price dipped and then recovered. The handle forms after the cup as a smaller downward consolidation, which then leads to a breakout. When you see a cup and handle forming, and the order book shows increasing buy interest as the price approaches the breakout point, it is often a strong indication that the price will rise further. Another pattern to watch is the ** triple top or triple bottom ***. A triple top forms when the price hits the same resistance level 3 times without breaking through, suggesting strong resistance, while a triple bottom indicates a solid support level that the price has tested 3 times. These patterns can be useful for identifying areas where the price may reverse. Observing the order book can help confirm these patterns if there are large sell orders at the resistance for a triple top or large buy orders at the support for a triple bottom. Understanding and recognizing these chart patterns is extremely valuable, but it becomes even more powerful when you combine it with the data from the order book. The order book gives you real-time insight into how strong the buying or selling interest is at key price levels, and that can help you anticipate whether these chart patterns will play out as expected. For example, a head and shoulders pattern followed by increasing sell orders can give you more confidence in expecting a price drop, while a double bottom with growing buy orders can signal a solid opportunity to enter a long position. Chart patterns alone do not guarantee what the price will do, but they give you clues that can be very helpful. Combining what you see in the chart patterns with real-time data from the order book and other indicators, such as volume, will give you a more comprehensive understanding of what is happening in the market and allow you to make better trading decisions. Let us talk about some important concepts that show up in the order book. One thing you will notice right away is the gap between the highest price that buyers want to pay and the lowest price that sellers want to accept. This is called the bid-ask spread. If the spread is small, the stock is said to be liquid. This means it is easier to trade because the price does not need to move a lot for buyers and sellers to agree. If the spread is wide, the stock is less liquid, and it might be harder to buy or sell without causing the price to jump around. Another key concept is market depth. This tells you how many shares are being offered at each price level. If there are lots of buy and sell orders, the market is deep and stable. If there are not that many orders, then the market can be more unpredictable. Also, pay attention to the types of orders in the book. Most orders you see are limit orders. This means that the buyer or seller has set a specific price. Sometimes you will see market orders, which are set to trade immediately at the best available price. Another essential aspect to understand is how these market concepts can directly relate to chart patterns. For example, a tight bid-ask spread combined with a deep order book often suggests stability, which could support the formation of patterns like ***, ascending triangles, ***, or ***, double bottoms, ***. In these cases, the balance of buy and sell orders helps to confirm the strength of these formations. In contrast, a wide bid-ask spread might contribute to more volatile movements, often leading to patterns like ***, flags, ***, or ***, pennants, ***, which are typically seen during periods of high momentum. Observing the order book during these times can help you identify whether there is sufficient support or resistance to validate a breakout. If there are a few large orders dominating at specific price points, this could also lead to the formation of *** head and shoulders *** patterns, signaling a potential reversal. Market depth also plays a significant role in confirming these patterns. For example, during a *** triple bottom ** formation, seeing deep buy orders near the support levels indicates that buyers are committed, which enhances the likelihood of a price bounce. Similarly, in an *** ascending triangle ***, if you notice a substantial increase in buy orders just below the resistance, it hints at a high probability of the price breaking out upwards. Understanding these order book dynamics alongside chart patterns can provide you with a more well-rounded view of market activity. For instance, while chart patterns might show a potential *** descending triangle ***, The depth and composition of orders in the book can either validate or weaken the signal. Seeing significant sell orders accumulating at lower highs can be a critical factor in anticipating the continuation of a downtrend. The more thorough your understanding of both chart patterns and order book data, the better your trading decisions will be. Reading the order book might seem like a lot at first, but it is actually pretty straightforward once you know what to look for. You always want to start by finding the best bid and the best ask. These are the highest price someone is willing to pay and the lowest price someone is willing to sell for. Between these two, you have the current market price. Alongside each price level, you will see the quantity of shares available. This is important because larger quantities often mean more interest at that level. For example, if you see a big number of shares at a certain price, it may mean there is strong support or resistance. Now let us talk about how these levels can form recognizable chart patterns. One such pattern is *** support and resistance zones ***, where the price struggles to move beyond a certain level repeatedly. This can be seen when there are consistently large buy orders at the same price level support or large sell orders at the same level resistance. The order book helps you visualize these levels as you see clusters of orders that indicate potential barriers to price movement. Another useful concept is the ** order flow and volume patterns ***. When observing the order book, if you notice a sudden surge in the volume of buy or sell orders at a specific level, it could signify a ** breakout, ** or ** breaked on ** is imminent. For example, an ascending triangle pattern often involves the price making higher lows while facing consistent resistance at a particular level. In the order book, you would see buying interest increasing at progressively higher levels, putting pressure on resistance. Once the resistance breaks, a strong upward movement typically follows. Similarly, in a ** descending triangle ** pattern, you might see progressively lower highs where sell orders dominate, while a support level remains firm until it is finally broken. This indicates increasing selling pressure. The order book will often show sell orders accumulating as buyers struggle to hold the price, signaling a potential sharp drop once support gives way. If you see ***, flag, and pennant patterns ***, they often involve brief consolidations after strong moves in one direction. In the order book, you might notice a clustering of orders in a narrow range after a rapid price increase or decrease, signaling a temporary pause before the trend continues. Understanding how these patterns manifest in the order book can help you spot opportunities to enter trades just before the continuation move begins. Watching how the order book changes over time is also very helpful. If you start seeing more buy orders coming in, especially at higher price levels, it could mean that demand is growing and the price might be ready to move up. This is typical behavior during an ***, ascending triangle ***, or when a *** cup and handle *** pattern is forming, as buyers become increasingly confident. On the other hand, if sell orders start piling up at lower and lower levels, it might mean that downward pressure is building, which is often seen in ** head and shoulders ** or ** descending triangle ** formations. You can use the order book to find opportunities to buy and sell. For example, if you notice that there are lots of big buy orders at a certain price, that could mean there is support, and that might be a good place to buy. The same goes for large sell orders. If you see many shares being offered at a price above where the stock is trading, that might act as resistance. When you understand the flow of orders, you get a good sense of what is happening in the market. If buy orders start stacking up and there are not many sellers, you might expect the price to rise soon. Similarly, if sellers are building up but buyers are disappearing, it could be time to think about getting out. Sometimes the order book will show an imbalance. This means that there are a lot more buy orders than sell orders, or the other way around. When there are many more buy orders, it can signal that the price might go up soon. If there are more sell orders, the price might go down. These imbalances can be very helpful in giving you a heads up about where the price might go before it even moves. Not all orders in the order book are what they seem, though. There are some traders out there who use tricks to make the order book look a certain way without actually planning to buy or sell. This is called spoofing. They might put in large orders to make it look like there is a lot of interest and then quickly cancel them before they are filled. If you see a big order suddenly disappear, it might have been a fake. This is why you should never make decisions based solely on one big order in the book. Instead, it is better to use the order book along with other tools to confirm what is happening. The order book works best when you combine it with other tools. For instance, watching the volume of shares being traded can give you extra confirmation. If you see strong support in the order book, but the trading volume is very low, it might mean the move is not as powerful as it seems. Adding technical indicators can also help. Moving averages, for example, can show you if the trend is continuing or if there might be a reversal. Together with the order book, these tools can give you a clearer picture of what is happening. Here are some practical tips for using the order book. First, always pay attention to the key price levels. These are the best bid and best ask, and any large orders that are close to the current price. These give you clues about where the market might move next. Also, keep an eye out for sudden changes. If you see a large order disappear or a new one appear quickly, it could mean a sudden shift in the market. This is especially important for short-term trading. If you are trading day to day or even hour by hour, these quick changes can make a big difference. There are some common mistakes that traders make when they are looking at the order book. One mistake is focusing only on the biggest orders. While it is true that large orders are important, sometimes the smaller orders tell a lot about what is happening in the short term. You also have to remember that the order book is just one tool. Always consider what is happening in the broader market, such as any news or major events, because these can have a big impact on prices. Finally, do not get caught up in every little change in the book. It is easy to get carried away and make decisions based on tiny moves, but it is better to wait until you have confirmation of a trend. If you are new to reading the order book, the best way to practice is by using a demo account. This lets you get comfortable with spotting patterns and seeing how prices react to changes without risking real money. It is also a good idea to keep a journal of your trades. Write down what you saw in the order book, what you thought would happen, and how things actually turned out. This way, you can learn from your experience and figure out what works best. It also helps to experiment with different stocks. Some stocks are very liquid, with lots of buyers and sellers, while others are not. Learning how to read the order book in different situations will make you a better trader overall. So to sum up, the order book is a powerful tool that gives you a real-time view of market supply and demand. Some of the key things to remember are the bid-ask spread, market depth, and the imbalances you might see between buyers and sellers. Always watch the best bid and ask prices. Look for large orders that might act as support or resistance, and combine what you see in the order book with other indicators like volume and technical analysis to make better decisions. Mastering the order book takes time and practice, but once you understand how to use it, it can really help you make more informed and confident trading decisions. Keep practicing, keep learning, and soon you will start seeing improvements in how you trade. Feel free to share your thoughts or questions, and let us keep learning together.